So there's really, it's a combination of 5 different parts or 5 different tools that the ZoneTraderPro platform is using. And if you didn't know, the VIX is the ticker symbol, and it's popular as the volatility index. And it is basically a measure of the market's expectation of volatility in the S&P options for the going out the next 30 days. That's the $ VIX. There's also falling implied volatility, and that is generally caused by an imbalance of options from option sellers over demand for options from the buyers. The daily change in the VIX is an indication of how aggressively the SPX option contracts are being purchased and sold. So why do we want to trade based with information based on these options? Well, options are, there's 2 types of options. There's our puts, which are bets that the options are going to go down, and calls, which are bets that the market's going to go up. And what's really interesting to understand is that options dealers will both buy and sell puts and calls. So they don't want to have a directional bias one way or another. And they do this by hedging. This is what I began to learn in 2020 from Spot Gamma. I am personally a paid subscriber. I don't earn any referral fees from them. The information about the options hedging and the VIX that Spot Gamma distributes is basically what led me to create what I've done here. So the sportsbook in Vegas and the options dealers have a lot in common. The sportsbook, they want an equal amount bet on each team. They do this by adjusting the line so that an equal number of bets will come in off of each side. They don't want to have a directional exposure and don't care which team wins. And the options dealers are the same way. He's going to both be buying and selling puts and calls. And if he is long, if he is what's called long a call, that is a bet that price will go up. A long put is an option bet that price will go down. So as puts and calls are bought and sold throughout the day, the VIX is going to move higher and lower. And that's basically why we're looking to follow that. When these puts and calls are being bought and sold to the dealers. If there's more fear that the market's going to drop, the VIX is generally going to move higher. The VIX was lower if calls are bought and puts are sold. And there's less fear that the market is going to drop. And that is basically what this slide is basically illustrating, what is going to happen and how a dealer is going to offset that. So if you go and you buy a long call, he's going to offset that by buying ES futures. If you are going to short a put, then he's also going to offset that by buying ES futures. The opposite is true if you're short a call or long a put. And this is how he's able to stay hedged until either the option expires or you close that trade. The dealer, he's making a hedge based on his delta. If the trade goes in his favor and expires, he can buy back that hedge. And that's sometimes what you see at the close. And he can be either long or short the ES futures. What happens when a trade goes against him? This is when the term gamma comes to apply. If a trade goes against the options dealer is going to have to hedge more and more futures as it gets closer to expiration and to the level that the price level that was in the option. He's going to have to continue hedging those futures until he's fully protected or the customer closes that position. Only when the position is closed can the futures hedge be bought or sold back. And this is super important, especially for puts that are monetized by traders at market lows. Super, super important.